Hi folks, I'm Scott Broberg, President of SBR Financial Group, and this is going to be the second in our series of videos on investment asset classes. We ended our first video on this slide right here, where we were looking at what we call traditional asset classes. And there's the big three: cash, bonds, and stocks. And then underneath them, we have what are called asset class categories or subcategories. So within the asset class of cash, you have a number of different subs. Just so you know that I lined them up here on this slide with the risk going from the lowest risk out to the highest risk. One of the characteristics of each asset class is going to be risk and expected return. I'm going to address that in a minute, but I lined them up here just so you know that they go in this particular order of lowest risk to a higher risk. So what happens when we look at not only just an asset class category, but then we want to know what's the sub. So if someone comes up to me and says, well, I'm invested in bonds, my first question as a financial planner is going to be, well, which bonds? And maybe it's a well diversified, meaning they've got any number of different issuers and any number of different time lengths. And but that's ultimately if there's a difference between corporate and muni. And so if he says muni bonds, now I have a sense of what the differences are, and then I'd want to know, well, are they short term, intermediate, or long term? And he might say intermediate. Now I have I'm narrowing down what this person's investment would be like. Or if you went into stocks, there's any number in here: large company, small. We could go growth and value. There's a number of ways that you can slice and dice this. But essentially, you have the three main traditional asset classes and then the subcategories below that. What I want to move to eventually in this video is to talk about alternative asset classes, because you might see things that you have investments in that are not listed here, and you want to know where do those fall. And those are going to be in the alternative investment asset classes. So let's go now, and I'm going to take one little intermediate step here. And there's a couple things that investors usually focus on when going into this whole idea of investments. The first one is, what's my expected return? And that would be return on investment. And we get this expected return from historical data. So if you're going to invest in municipal bonds, we can look at all of the thousands of data points that we have on municipal bonds and say, well, the historical data would tell us that your expected rate of return is going to be X. And if you want more than X, then you don't go to municipal bonds. You have to go somewhere else, because that's going to have a different expected return. But this is something that everyone wants to know. What's the expected return? But also, and even more important, is what kind of risk do I need to take in order to get this expected return? And one way that we look at risk is, what kind of deviation will we experience over time with this particular investment? Let me draw a picture here just to show what I mean. So if we're measuring risk versus reward, and let's suppose that whatever, I'm not going to assign a number to this, but let's suppose that our investment, if this were a number, would be our rate of return over, let's say, 10 years. So we look back at the historical data and we say the historical data tells us that we would have some kind of rate of return that looks like this. And then you say, okay, well, what were the deviations that were experienced while this investment was growing? Because we know that investments don't grow in a linear fashion. They will go up, and then they'll decline, and then they go up, and then they decline. And this is what we typically picture the stock market picture for us to look like. And it could be the bond market. And what we want to know are, what are these deviations? So each quarter, when I open up my statement, am I going to be shocked that I was here and now I'm here? And how big is that drop going to be? You could also say, let's have a line that looks something like this. If we had the same return line, but it looked like this, so that you're barely deviating from your value. It might change very slightly over time, but it's just a very slow, steady growth. So that's our risk deviation. It's, what does this look like? What's the path going to look like that we're taking there? It's typically here where investors say, I want to get out, because they don't like this path. They like the path going up. Okay, now here's one of the things. We're going to talk about traditional versus alternative investments. So we're going to get into alternative. Well, one thing about traditional investments is we have a lot of this historical data. And if you go to the stock market data and see how many times a stock is traded every single day on the equity exchanges, we have a lot of information. When you get to the more obscure, possibly alternative investments, the data can become more sparse. Well, that data, the historical data for each investment, is what's going to help us determine expected return and what kind of risk you're going to have to take in order to get there. So for instance, an alternative investment might be your brother-in-law comes to you and says, would you like to take all of that 401k that you have and invest it in my new business? You'll be the only shareholder. Well, what historical data do you have for your brother-in-law's business? And the answer is zero. So you have to, now you're on the risk spectrum that's way out, because you could get a really high return. You could also get a really awful return, like lose all your money, because you have zero data to be able to analyze this. So one of the things that, as we get into the more alternative ones, one could argue that, well, we don't have as solid of data as how these are going to perform over time as we would the more traditional ones. Not always, but just that's one factor that goes into this. Okay, so these are our two big things we want to find out. And each asset class, I should say this. So each asset class is different. Return, deviation. Okay. All right, let's move on here. So then where we're going next is what we would call alternative asset class. So what makes this alternative? Well, it could be any number of things. One could be the absence of a market. For instance, what I mean by that is stocks are traded. We know they're traded on a stock exchange, and they trade millions of shares each day. But if you have an antique that doesn't trade very often and is very unique in its in what it is, some kind of dresser from the 18th century, whatever it is. Well, it's really hard to compare to find price discovery. So, in the absence of a market, it's very difficult to get price discovery, and it might even be difficult to find liquidity. So, this is one thing that might make an alternative investment different than a normal investment. Well, let's go through some of these. What would we come up with if we were to look at alternative investment classes? Well, we have things like metals. And would it surprise you that they would have subclasses here? So you could get precious metals, or you could get industrial metals. So aluminum is never considered to be, or titanium is not a precious metal, it's industrial metal. Okay, you could go to real estate, and you could be in the form of a traded REIT, a real estate invested trust. So REIT, real estate investment trust. Or you could do a non-traded REIT. Now the traded REITs these days are considered more, I'm going to put a little asterisk, those are considered more in the traditional, and I mentioned that in my last video. So non-traded. You could then have all kinds of subs to these, right? So it could be office buildings, it could be retail, it could be storage, it could be lumber. So all of those are going to have different characteristics underneath the idea of real estate. You have commodities. You could go energy, natural resources. Oops, spelled that wrong. Sorry. Natural resources. Got that all jumbled up. Let's see, what else do we have here? You could go as far as like art. So you have art dealers and art brokers. You could go to coins. You could go to fine wines. You could go to stamps. Now these are really getting out into the realm of the idea of illiquidity and things that most people wouldn't normally get into, but they still are on the list there. Another one might be something like managed futures. Hedge funds. Now, depending on what's being offered and to whom, one of the things that regulators do, because these can be so difficult to analyze, and they can be very difficult as far as they're not following the normal market cycles that we look at with equity, bonds, and cash. So because they become difficult to analyze, regulators will often do something like place a net worth or an income requirement for a financial advisor to offer you one of these. So in order to get into a hedge fund, you typically have to be what's called an accredited investor. So you can't walk up to the regular Joe Schmo on the street and say, would you like to get into a hedge fund? It's assumed because the accredited investor has more wealth and has more income that they're able to pay someone to help them evaluate what they're about to do. In the state of California, just so you know, if you're going into a non-traded REIT, there are limitations on net worth and income because there are liquidity issues. So in all of these, oh wait, you know what I could put in here? Currencies. Sorry. Currencies are another one that people can trade. So all of these would be considered alternative asset classes. Now again, you can go back and, if you go to commodities, these get a little bit Commodities and real estate start to move a little bit more towards the traditional because of the amount of data that we have on them. That data helps us to evaluate it and get an expected rate of return, also adding in what kind of risk in the form of deviations would you have to endure. So this is a list of your alternative asset classes. Again, the same idea though is you have to look for what kind of expected rate of return would I get and what kind of risk do I have to take for that. What we typically see is that when the stock market goes down, and that's where most people's focus are, one of these alternatives will pop up and become very popular for a short period of time until people realize, well, you're actually accepting the same, if not greater risk in one of these alternative investments than you would just in the stock market. Notice there was a period of time where gold was going way up and everybody was trying to pile into gold. And then it was, well, you better get into aluminum or you better head to real estate. And so you don't want to be chasing any of these, although they can augment in a portfolio. All right, so we hope this helps investment asset classes. This is, again, as we go into more portfolio development, into diversification and asset allocation, these are some keys to understand what happens when you add one of these into your portfolio. For more information, watch any of the videos that we have on our website. Also at the website, sbrfinancialgroup.com, we do have more information, articles on all of these topics. So we'll see you next time in the video.